After years of watching markets rise and fall, I can tell you the moment that actually hurts you is never the one that feels dangerous. It's never the crash itself, because by the time the crash arrives, your money is already gone. The moment that actually hurts you is the one that feels like a party. The one where everyone around you is getting rich, the headlines are glowing, and you feel almost stupid for asking questions. And I think we are standing inside that exact moment right now, because underneath the celebration, something quiet is happening. The definition of a safe investment is being rewritten without anyone's permission, and a bill is coming due. The only question left is who's going to be holding it when it does. By the end of this video, you'll understand exactly what's happening behind the scenes of the AI boom, why the timing of what's happening right now is different from every other AI scare you've heard about, and how to make sure you're not the one left holding the bag. Picture a party. The music's loud, the drinks are flowing, everyone's laughing a little too hard because the night feels magic. And then, if you look closely, you notice something. The people who actually own the house, the ones who know exactly what's going on behind the walls, are quietly slipping out the back and calling cabs home. They're smiling on their way out. They're telling you to stay, to have another drink, that the night's still young, and all the while, they're leaving. That should raise one question in your mind. What do they know that you don't? Because that is exactly the scene playing out in the AI industry right now. This year, SpaceX finally went public, and its debut sent a jolt of energy through the entire market, with the stock ending its first day of trading at a valuation north of $2 trillion. That kind of number does something to people. It makes AI and the companies around it feel unstoppable, feel like the only trade that matters. But underneath that excitement, something else has been happening that barely got a fraction of the attention. Hundreds of current and former OpenAI employees, people who have been on the inside since the early days, who can see the real numbers behind the curtain that you and I will never see, sold roughly $6.6 billion worth of their own personal stock on the private market. 6.6 billion with a B. These aren't outsiders guessing about the future of the company. These are the engineers and early hires who built the thing with their own hands, and a meaningful chunk of them decided that now was the moment to cash a portion of their winnings out and hand the shares to somebody else. So who exactly is on the other side of that trade? Somebody has to be, and it's worth asking honestly whether that somebody, eventually, ends up being you. Because it isn't just OpenAI. Anthropic has now been valued at close to $1 trillion after its most recent funding round, and OpenAI itself has been pushed as high as roughly $850 billion in its own private markets, with talk of a public listing that keeps getting pushed further out, first this year, now reportedly slipping toward next year. Think about what that tells you. The two most talked about AI companies on the planet, sitting at valuations most of us can't even picture in our heads, and the timeline for actually opening themselves up to public investors keeps moving. When the biggest names in a boom keep delaying the moment ordinary investors can buy in, while insiders quietly cash out in the private market beforehand, that pattern has shown up again and again, right before the air comes out of a bubble. It's not proof of anything sinister on its own, but it's not nothing either. Now, I want to be fair here, because I always try to be. None of this, on its own, is evidence of a scam. SpaceX is a real company that launches real rockets that go to actual orbit. OpenAI has real revenue, tens of billions of dollars a year in it, and a product hundreds of millions of people genuinely use every single day. The people selling their shares might just be normal humans who worked incredibly hard for a decade and finally want to buy a house, pay off debt, or take a little bit of chips off the table after years of risk. That is completely human, and it's completely reasonable. But here's the uncomfortable truth. An honest insider, simply cashing out for personal reasons, and a sharp insider, quietly heading for the exit right before the top, look absolutely identical from where you and I are standing. The only way to actually tell the difference is to stop watching the party and start following the money. And once you do that, you start to see why this particular moment in the AI story is different from every other scary AI headline you've correctly ignored over the last few years. To understand why, you need to understand a bit of a magic trick that's been quietly running under this entire boom from the start. We like to talk about the stock market as if it's some enormous vault stuffed with money. In reality, it's closer to a confidence machine. It runs on agreement, on belief, and on the price of whatever the last trade happened to be. A company can gain hundreds of billions of dollars in value without a single extra dollar actually existing anywhere in the real world. Here's how. If a company has, say, 1 billion shares outstanding, and one single buyer purchases just one of those shares at a higher price than the last person paid, Every other share technically gets repriced upward to match. On paper, the whole company just got more valuable. But did anywhere close to that much actual cash change hands? Not even close. Think about it like the houses on your own street. Imagine the place 3 doors down sells for a record price, way beyond what anyone expected. Suddenly, every homeowner on that street feels richer, because the estate agents start telling everyone the whole street is worth more now, and in a sense, it is. But notice something. Nobody actually handed you or your neighbors a check. You just feel wealthier because of the price somebody else agreed to pay for a completely different house. That wealth is real and unreal at the exact same time. It exists right up until the moment everybody tries to cash out simultaneously, and only then do people find out what the street is actually worth. That is what the AI trade has been running on for the past few years. The value has largely existed as belief, marked up to the price of whatever the last private funding round happened to be. This boom never really had to prove that huge numbers of outside investors would actually show up with real cash. It only had to be believed in for the number to keep climbing, and to be fair, that has worked beautifully. But now, with a wave of enormous AI-linked companies edging toward the public markets, and hyperscalers spending unprecedented sums to build out the infrastructure underneath all of this, the boom doesn't just need belief anymore. It needs to be funded, in cash, by real people and real institutions. That is the line we've just started crossing, and once you cross that line, the question changes. It stops being, do people believe in AI? Because clearly a huge number of us do. It becomes, is there actually enough real money sitting in the system to pay for everything everyone currently believes? When you sit down and try to add up that bill in actual dollars, it's a genuinely staggering number. Start with the infrastructure itself, the data centers, the chips, the power plants needed to physically run all of this artificial intelligence. The major cloud and AI companies are now collectively committing somewhere north of $700 billion in capital spending this year alone on data centers and chips. $700 billion in a single year from a small handful of companies. And behind that spending sits another layer, the enormous private valuations of the AI labs themselves. OpenAI and Anthropic combined worth close to $2 trillion on paper, based almost entirely on private funding rounds rather than a public market that's actually tested the price. Put those two numbers together, the infrastructure build-out and the valuations riding on top of it, and you get a mountain of capital that this industry needs to keep finding, year after year, just to keep the engine running at its current speed. So where does all of this money actually come from? Because there isn't some secret reservoir of brand new cash sitting untouched, waiting to be poured into AI. For investors to put hundreds of billions of dollars into new AI-linked shares, they first have to free up that cash from somewhere else. And to do that, they have to sell something they already own. Maybe some Apple, maybe some other big tech names, maybe a slice of their boring old index fund. The money used to buy tomorrow's winners has to come, in large part, from selling today's winners. Sit with that for a second. This boom has grown so large that, in a very real sense, it now has to cannibalize other parts of the market just to keep feeding itself. That isn't a growing pie where everyone quietly gets a bigger slice. That's a game of musical chairs, and right now, a record number of players are standing up at the exact same time, reaching for the exact same chair. Maybe the demand for these companies is so enormous that the whole thing simply gets absorbed without anyone really feeling it. Maybe there's genuinely enough capital sloshing around the global economy to soak all of it up without a hitch. But here's the part I want you to actually notice. Even in that best-case scenario, it still requires an absolute fortune of existing stock to be sold, just to make room for the new stuff. So the real question becomes, who ends up doing the selling, and who ends up doing the buying at these extraordinary prices? That's where this story gets genuinely clever, because the people running this industry are not naive. They know the cash problem is real, and they have quietly built two solutions to it. And honestly, as someone who's watched a lot of financial engineering in his life, I have to admit, it's almost impressive how it's constructed. Here's the first one. Nvidia, the chip company that makes the hardware everyone in AI is desperate for, has invested tens of billions of dollars directly into OpenAI. Straightforward enough on its own. OpenAI, now flush with that cash and billions more from other backers, turns around and commits enormous sums to buying computing power from cloud providers like Oracle, AMD, and Amazon, tens of billions of dollars in each direction, all spent on the capacity needed to train and run its models. But here's the twist. What do those cloud providers do with a large chunk of the money OpenAI just paid them? They turn around and buy chips. And who makes the chips almost everybody in AI is fighting over? Nvidia. So the money goes in, and it comes right back around to where it started. It's a closed loop, and every single lap it takes pushes valuations a little higher across the whole ecosystem. This loop has been spinning smoothly for a couple of years now. I want to be fair to the other side of this too, because there is a genuine argument for why this isn't purely smoke and mirrors. By locking in these commitments ahead of time, the companies involved guarantee themselves the chips, the data center capacity, and the customer relationships in a world where everybody is fighting over the exact same scarce resources. That's a real strategic advantage. But there's a real vulnerability hiding underneath it too, because a closed loop of money that pays itself can look exactly like explosive organic growth for a very long time, even long after genuine outside demand has started to plateau. As long as the money keeps circling among the same small handful of insiders, the numbers keep climbing and everybody stays happy. The loop works beautifully right up until the moment it needs a fresh injection of cash from outside the circle to keep spinning. And what do you think this entire wave of public listings and private mega rounds actually is? That's exactly that moment. For the first time, the circle is reaching outside of itself, and it's knocking on the door of the public market, asking regular investors like you to help keep it spinning. Which brings us to the second, and honestly far more important, solution for everyday investors like you and me. Because the industry doesn't just need to find new willing buyers. Plenty of people would happily buy in on their own. What it really needs is a way to bring in buyers who don't even realize they're buying. And it turns out those forced buyers might genuinely be you. This part is the one that stopped me cold when I first understood it properly, and I think it's worth sitting with, because it has a direct impact on your retirement account whether you've ever bought a single individual AI stock in your life or not. Almost everyone, including probably you watching this, has been told that index funds are the sensible, grown-up choice. Just buy the whole market. Don't try to be a hero, don't pick individual stocks. Put your money into a boring, diversified fund that owns a slice of everything, and you'll be shielded from exactly this kind of speculative frenzy. That's been extremely good advice for decades, including from me. But here's what you need to actually understand. An index isn't the market itself. An index is a list. And that list is created, maintained, and edited by companies like the major index providers, businesses that compete with one another for relevance and for customers who track their particular list. In a world where the most exciting, headline-grabbing companies are these giant new AI-linked listings, some of those index providers have quietly loosened their own rules about how fast a brand new company can be added. Normally, when a company goes public, it has to wait. It sits in the open market for months, sometimes close to a full year, before it's eligible to be added to a major index. That waiting period exists for a genuinely good reason. It gives a wild, hyped-up opening price time to calm down and settle closer to something resembling reality. Some major index providers have shortened those waiting periods dramatically for the biggest, most closely watched new listings, allowing a brand new, completely untested stock to be added to funds within just a matter of trading days rather than months. That means a wildly speculative, barely seasoned stock can land inside your supposedly boring, sensible index fund almost immediately, right near its most inflated, most hyped opening price. Some analysts estimate that funds tracking these broader indexes could be forced to absorb a meaningful double-digit percentage of a hot new listing's available public shares almost overnight, simply because the fund's own rules require it to hold whatever's on the list. Now, credit where it's due. Not every index provider caved to the pressure. Some of the more conservative index families held their line and kept the traditional, longer waiting periods in place, which, in my opinion, was the right call. But the problem is that not all of them held firm, and tens of millions of ordinary people hold funds tracking the indexes that did loosen their rules, without ever having read the fine print sitting underneath them. This is the quiet handoff happening in real time. Insiders sell their private shares. Index rules get adjusted in the background, and the speculative risk gets transferred, almost automatically, into some of the most conservative, most trusted retirement accounts on the planet. You were told you were buying safety. What you might actually be buying is the very top of the riskiest moment in the entire AI story. But look, maybe none of that matters if the underlying businesses are genuinely as profitable as they appear on paper. So let's actually look at the foundation underneath all of this and ask an honest question. Are the reported profits of these AI-linked giants even real in the way they're being presented? You've probably heard of Michael Burry, the investor famous for correctly calling the 2008 housing crash when almost nobody else saw it coming. He's been wrong plenty of times since then, and he's a controversial figure for good reason, but I still think his argument here deserves to be heard out loud. His case is built around one boring-sounding accounting concept: depreciation. When a massive cloud or tech company buys billions of dollars worth of AI chips, it doesn't count that entire cost in the year it's spent. Instead, it spreads that cost out over several years, based on how long it expects those chips to remain useful. That's completely standard, sensible accounting. But Burry's argument is that spreading these particular costs over 5 or 6 years doesn't really match reality, because these chips don't stay competitive for anywhere close to that long. In a field moving as fast as this one, a cutting-edge chip today might only remain genuinely top tier for 2 or 3 years before the next generation makes it look outdated. So if a chip is functionally obsolete in 3 years, but a company is accounting for it as if it lasts twice that long, the company is, in effect, undercounting its real costs every single year. And if your costs look smaller than they truly are, your reported profits look bigger than they truly are. This might sound like a small technicality, but the scale involved is what makes it significant. Burry has argued this kind of accounting choice could be masking tens of billions of dollars of understated costs across the industry over just a few years, which would mean that some of the exact earnings figures Wall Street is using to justify these sky-high valuations could be meaningfully overstated. He's pointed at specific companies by name, arguing their reported profits could be inflated by something in the range of 20 to 30%. Now, I want to be careful here, because this is a thesis from someone who has been dramatically right once in his career, and also wrong about plenty of other things since. It is not a proven verdict, and there are very serious, very smart people who disagree with him entirely. These companies have real revenue, the chips have real value and real utility. Independent analysts have said they can't confirm the practice is being abused in any deliberate way. So I'm not sitting here telling you the books are cooked. I'm simply putting in front of you what a credible, if controversial, voice is actually arguing, so you can weigh it yourself. And here's the thing. You don't need Burry to be completely right for this to matter. You only need him to be even partially right, because if he's even roughly in the neighborhood of correct, then the foundation underneath some of these record-breaking valuations is softer than the current price is quietly assuming. So let's stack the whole picture up together. Insiders are cashing out real money while the public listings keep getting delayed. Real cash across the system is being stretched thinner than the excitement suggests. A closed loop of financing is paying itself again and again between the same small circle of companies. Index rules have been quietly loosened in a way that turns ordinary retirement savers into forced buyers. And now there's a legitimate, if unproven, question mark hanging over whether the reported profits underneath all of it are even what they appear to be. Any single one of these on its own would be nothing worth losing sleep over. But all 5 lining up at exactly the same moment, that's not really a coincidence. In my experience, watching more than one of these cycles play out over the years, that combination is what it tends to look like right before a bubble finds its breaking point. At this stage, you might be wondering, is this just the dot-com crash all over again? Is the entire AI story secretly a fraud waiting to be exposed? And the honest answer is no. AI is not fake, and it is definitely not a fraud. But strangely, that turns out to be the single most dangerous part of this whole story. A lot of people assume that if a technology is genuinely real and genuinely transformative, then investing in it must automatically be safe. It feels intuitive. If the thing is truly going to change the world, how could you possibly lose money betting on it? But that assumption is one of the most expensive mistakes an investor can make, and history has proven it wrong again and again. Let me be absolutely clear. I am not telling you AI is fake. I am telling you the exact opposite. AI is real. It is going to reshape huge parts of the economy, and it is unquestionably here to stay. But the greatest financial bubbles in history were never built on lies. Look at the railroads in the 1800s. They genuinely did connect entire continents and reshape civilization forever. And investors who piled in at exactly the wrong moment were still wiped out. Look at the internet in the late 1990s. The internet did, in fact, change everything, exactly the way believers said it would. And that bubble still destroyed enormous personal fortunes when it finally burst. The lesson here is that a technology being real is not your protection. If anything, the technology being real is the bait. A fake story or an obvious fraud is something your instincts naturally reject, because your guard stays up automatically. But a genuinely world-changing story is precisely what convinces sensible, careful people to pay almost any price, because deep down, they know it's the future. A bubble doesn't pop when people stop believing in the underlying technology. People believed in the internet the entire way down, through the crash and out the other side. What actually causes a bubble to burst is when the cost of continuing to fund the story gets too high for the system to sustain. And in every one of these historical episodes, the people who got hurt weren't the ones who believed in railroads, or the internet, or now AI. The people who got hurt were the late buyers, the ones who showed up right at the peak, handing over cash for shares just before the money got tight and the selling began. So ask yourself honestly, who is quietly being maneuvered into the role of the late buyer this time, potentially right at the peak, through their perfectly boring, perfectly sensible index fund? Go look at your own portfolio, and ask whether you might be unknowingly holding a small slice of exactly that. So after all of this, you've probably got one question left for me. What am I actually doing about it personally? Let me give you my honest answer. There are two obvious moves people want to make in a moment like this, and I think they're both traps. The first is betting against AI entirely, shorting the stocks, trying to play the Michael Burry role from the housing crash. I won't be doing that, and I wouldn't recommend it either, because the technology is genuinely real, and betting against real technology is one of the fastest ways to lose everything. The second trap is the complete opposite, piling into every AI-linked IPO and secondary sale at any price, purely out of fear of missing out. I won't be doing that either, because the current prices are, frankly, already pricing in a level of perfection that leaves almost no room for anything to go wrong. The real move isn't trying to predict the exact top, because let's be honest, nobody can reliably do that, myself included. What you can actually do is make sure you're not the forced buyer left holding the bag when the music stops. Here's what that looks like in practice. First, know what you actually own. The phrase, "just buy the market," stopped being a free pass the moment index rules quietly changed underneath it. Go look under the hood of the funds you already hold. Find out how quickly new, unproven companies get added, and how much weight the largest handful of names now carry inside a fund that's supposed to be diversified. You might be completely comfortable with what you find. Just make sure you actually look instead of assuming. Second, don't let a rule change choose your risk level for you. If you genuinely want direct exposure to these speculative new AI companies, that's a perfectly valid choice to make. But make it on purpose, with your eyes open, not by accident through a fund that quietly absorbed it for you. Third, let new companies actually prove themselves before you chase them. A genuinely great company can still be a terrible investment at the wrong price and the wrong moment, and patience has saved more portfolios over the decades than almost anything else. And fourth, keep your costs low and your head clear. When everyone around you is celebrating, and it feels like you're the only cautious person in the room not getting rich, that feeling itself is usually all the information you need. It's often exactly what it feels like right before the top of a bubble. I've lived through more than one of these cycles now, and the lesson is always the same, and it's never the one people want to hear while the party's still going. The riskiest moment never feels like the riskiest moment. In fact, it usually feels like the complete opposite, which is exactly why it pays to slow down, do your own research, and think critically before you follow the crowd through the door. Otherwise,